We are back coming at you live, and we're going to run through the changes we've made. And we've had quite a bit of a good run here in our portfolio. And we expect that to continue because we're very confident in our positioning. So we're going to share that. Ultimately, the theme that we're adopting right now is we don't want to fight the Fed. And what does that mean in this environment? Well, we've had this tremendous rally. The NASDAQ is up some roughly 20% off the lows. S&P 500 has erased nearly half of its losses for the year. We've had a big run, and I have ridden this wave of the run to a meaningful extent, and I think it's coming to an end. I think it's coming to an end because yields are too low. It seems that the market bottomed when yields topped, and then yields fell and the market rallied. So we all know there's a strong connection between the market and yields, but the yield picture doesn't make sense. I just want to reiterate one more thing about yields before we get into how it doesn't make sense. We had a tremendous bull run from 2020 off the lows because of the Fed coming in, stepping in, taking yields lower. As soon as the Fed pivoted and decided to increase yields, the market had the second worst start in history and the worst start in over 5 decades. So this is an important phenomenon. Don't fight the Fed. That's the point of this video. Don't fight the Fed. The market had a tremendous rally when Jerome Powell spoke, came on, and basically said nothing and was incredibly ambiguous. The lack of clarity and the lack of forward guidance, people interpreted as a dovish symbol, and that the Fed had pivoted and was now going to begin to cut rates in the future. That was getting priced in, that they were going to take this pause, that they weren't going to do a whole lot, et cetera, et cetera, et cetera. Peak inflation, you know the whole shebang. However, right after that, the Fed did decide to provide some forward guidance and did decide to supply some clarity. So it's no longer ambiguous what the Fed is going to do. That was the initial reaction. That's what, Big Chairman Powell said and how he made it seem, and I get it. That's, how people interpreted it. That was the initial reaction. I even had a little bit of some of that interaction, or reaction, whatever. But now we're getting 3.75 to 4 federal funds rate by the end of the year, Bullard. Mester's saying 4. Some are saying 3 to 3.5. That doesn't seem to be the case. It definitely doesn't seem like it's going to be the median. We're talking 75 bips next meeting. That's going to bring us to 3 to 3.25. We're assuming we don't have to hike again, but we're going to hike again beyond that. And here's why. They need several consecutive months of inflation meaningfully declining. I don't know what the CPI is going to be tomorrow, but we're seeing 8.8, 8.7, okay? That is nothing. That is nothing. That is still 8% inflation. That's a small tick. That means absolutely nothing. Get that out of your head. Why get that out of your head? People are talking about, gas prices are coming down, gas prices are coming down. Guess what? The Fed publicly and explicitly says they look at PCE inflation, which excludes food and energy. I get it. Commodities have rolled over. I'm not convinced. Lumber's basically flat the last month. Or not lumber, rather. Copper's basically flat the last month. Lumber's up 6% today. There's a housing market slowdown. Lumber's up 6% today. Gold is up. Wages are doing nothing. If anything, wages are going up and employment is quite hot. We know the Fed cares about employment. They're not seeing it. The Fed is not dovish. They did not pivot. If anything, they're getting more hawkish. So don't fight the Fed. They're the single most important force in the market. They gave us a tremendous bull run. They gave us the second worst decline in history and the worst decline in over 5 decades. We have to stay with that. So, what am I doing? Doing a couple things. You all know I'm expecting rates to go up if I haven't made that clear already. So I've got good position on that. Added to that position periodically. Added to it yesterday. Added again to it a little bit today. I'm kind of just nibbling on that, looking for the year-end timeline, and we'll see what happens. Additionally, I've added some shorts the past couple of days. Added all of these shorts yesterday, actually, when the market was up in the morning. And again, we are expecting a pullback here, so we take advantage of that. I went short Bumble. We saw what happened with Match Group. Bumble seems to be unmoved on this bull run. I think they're going to come down. We're going short. Coinbase. We went short Coinbase yesterday rather. There's a lot of chop today after earnings. Looks like there's some short covering. I'm going to let that subside, and then I'm going to cover that short at a big gain. So crypto yields, very connected like everything else we've talked about in this video. Short Coinbase, going to close that out because there's such a tremendous gain there already. We're going to close that out. We were short Coinbase. Also short Bitcoin. We like Bitcoin. We definitely want to get back into it at some point. But just like the market, it has adjusted with the Fed and with yields. So we've seen this run in Bitcoin. That gives us some exposure to downside. We're not expecting a tremendous run in Bitcoin anytime soon. Yes, I get it. It's supposed to go up with inflation, but that doesn't seem to be happening. It seems to be moving more with yields. So we've done that. We've gone long gold miners particularly. We did that late last week. And we've taken some gains. We've been, slicing pieces of positions off. Sold another 1,000 shares of Uber yesterday. Sold some 23andMe. Sold Smile Direct Club after very disappointing earnings. So we've got about a 20% cash position, a 10% bet that yields go up, a 10% commodity position, roughly 10% in shorts, and we've got some just positions we're just going to continue to hold. But you know how much I like CRISPR. I'm totally out of CRISPR. I'm expecting to get back into it. I'm expecting a pullback, particularly in tech stocks, which are up tremendously right here. So we're going to see what happens. We've got 20% cash. We're ready to buy at the right time. But again, we expect one more leg lower. I don't know if it's going to take out the absolute low. I don't know. I think there's a chance it doesn't. ARK bottomed May 12th. Yields topped mid-June. Market bottomed mid-June. Seems like there's something there. Seems like ARK has pulled in a whole lot of rate expectations. That's okay. But that doesn't mean they can still pull back when rates go up. We think rates have yet to peak. So we'll see what happens. That's today's video. And until next time, peace out.